Well, today we've got a very almost famous South Australian. He heads up the largest brokerage business, financial brokerage business, and a lot more. Mark Lewis, Executive Chair of Bernie Lewis. How are you?
Good, thanks, Anthony.
So let's look at someone who's watching this. They've just heard the stuff we read in the papers. Now, you and I are both positive guys. We get up in the morning, we get into it. What would you suggest now is some of the really great stuff that's happening?
This is something I will hang my hat on.
That's right, that's good.
Yeah.
That's what we want. We want some statements.
Interest rates are going to come down.
Great. I agree.
Right?
I agree with that.
Absolutely no doubt interest rates are going to come down.
Mind you, Ralph Norris yesterday, Commonwealth Bank, said that the cost of money is going to increase, and he said the rate's going to go up. But their rate, their variables dropped 0.1% this week.
Well, yep. I mean, CBA has come out with a no-fee home loan, which the fees are a big debate. They've responded to the market and come out with a no-fee home loan. But you look at 3-year fixed rates. 3 weeks ago, they were up around 7.3, 7.4%. You can now get a 3-year fixed rate down at 6.5%.
Yes, so
now,
that's
the banks, you will never win betting against the market on interest rates. So the market will always beat you, and so whilst I'm an advocate of staying variable for that very reason, they're also a very good lead indicator of where rates are heading in the future. So interest rates going down.
Right,
now,
so that's
now
a statement.
Bill Evans came out.
Hang your hat on this.
Yep, Bill Evans, the Westpac economist. It's funny. I was sitting next to him at a lunch about 3 months ago, just a budget. And he was sort of on the fence at the time, thinking, not sure where interest rates were going to go, but predicting maybe one more, maybe two more small rises over the course of 2011 and early 2012. And he was the first economist to come out and say interest rates are going to drop 1%. Now, there's still economists out there saying interest rates are going to go up, but
you can smell it in the streets.
Every indicator that's out there, the unemployment rate is starting to go up, job ads are
dropping.
Dropping. They're 49% lower than they were in July 2008.
And I read an article, if you factor in the part-time, it's a much higher rate than that.
Yeah. Now, the problem we've got, and we come back to Buffett's great comment, be greedy when others are fearful. Well, the fear is out there now. If people sit there and wait for interest rates to move before they move, the fear's gone out.
Yep.
So you've kind of missed the boat. So, I guess the advice would be to, if you can, get in there now. And the banks are wanting to lend. Back in the height of GFC and certainly through 2009, it was more difficult to get a loan than it had been previously. And we sort of joked around in the office, if you had a pulse and a signature, then you could get a loan. And that now they're sort of reading applications.
You're hearing it live. You're hearing it live. Yeah, this isn't admission. We got it on record.
But now they're actually reading application form. And that's very tongue in cheek. But the fact is that the banks did tighten up on credit criteria, and the reason for that was largely because of cost of funds, and the funding sources were limited. Funding is not so much of an issue now, despite what Ralph Norris has said, and with all this, we come back to the coiled spring of all this cash sitting in the economy. It's going to be looking for places to go.
You can't just leave it there. It needs to be put to work.
I think funding will actually get better for the banks over the next period of time.